You did the math, maybe more than once. $2,500 a month from your pension, $1,800 from Social Security. That's over $50,000 a year in guaranteed income. Before you touch a single dollar of savings, you ran the numbers forward, multiplied it out over 25 years, saw a present value that looked solid, respectable, maybe even comfortable, and for a moment you exhaled. But here's something the net worth spreadsheets don't show you. At age 62, 63, 64, when those income streams start stacking on top of each other, the IRS has a formula, a quiet one. Most people have never heard of it, and it doesn't care how hard you worked or how long you waited. It's called the tax torpedo, and it works like this. Your pension income, which is treated as ordinary income, gets added to half your Social Security. If that combined number crosses a certain threshold, and for most people with a pension it does, up to 85% of your Social Security benefit becomes taxable, not the excess. 85% of the whole thing. The number on your benefit statement doesn't change, but what actually lands in your checking account does. I've watched this happen to people who planned carefully, people who did everything right, not because they made bad decisions, but because no one explained how these income streams interact once they start flowing at the same time. Today, we're going to walk through how the pension system actually works, the 3 decisions you can't take back once you sign the retirement paperwork, and exactly how the tax torpedo gets triggered, and how to diffuse it. If you're Gen X, somewhere between 55 and 65, and you're starting to land this plane, hit subscribe. We're going to keep as much of that money in your pocket as possible. Let's start with the basics, because most people get this wrong and it costs them. There are 2 kinds of retirement plans. A defined contribution plan, your 401k, your IRA puts the risk on you. The market goes up, great. The market drops in the wrong year, that's your problem. You're managing the uncertainty. A defined benefit plan, a traditional pension, flips that. Your employer promises you a specific monthly payment for life, no matter what the market does, no matter how long you live. The longevity risk, the investment risk, those transfer to them, not you. That sounds like a clear win, and in many ways it is. But the word guaranteed has fine print. I still remember that feeling, holding a 15-page HR retirement benefits form, trying not to check the wrong box, knowing that one mistake could affect 30 years of accumulated rights. It doesn't matter if you have $1 million in net worth. That moment is uncomfortable for everyone. And here's where people get into trouble. John is 60. He spent 9 years at a private company, decent salary, solid work, thought he had a pension waiting for him at the finish line. Then the layoff came. He figured, okay, at least there's something there, a small cushion. What he didn't know, what nobody told him clearly, is that his company required 10 years of service to be fully vested. He was 1 year short. At age 65, his pension pays him less than $500 a month, 1 year. That's the margin. Vesting schedules are not standard. Some plans cliff vest, meaning you get nothing until you hit a specific year, then everything. Others grade in gradually. If you leave before you cross that line, you may walk away with far less than you assumed. So the first thing to know about your pensions is, find out exactly where you stand on vesting. Not roughly, exactly. Now, what if your employer goes under? What if the fund is underfunded? There's a federal safety net called the PBGC, the Pension Benefit Guaranty Corporation. It steps in when private pension plans fail, but it comes with a ceiling. In 2026, the PBGC maximum annual guarantee for someone retiring at age 65 is around $81,000. For most people, that's enough. but for higher earners expecting a large pension from a company that collapses. The gap between what was promised and what the PBGC covers can be significant. Guaranteed is real, but it has limits. And this brings us to the deeper trade-off, the one people rarely say out loud. If your pension is your entire plan, if you've spent 25 years assuming that monthly check will handle everything, you've placed your financial future in the hands of one institution's financial health. One company, one state budget, one fund manager's decisions made decades ago. That's not paranoia. That's just what the structure means. A pension is a powerful foundation, but a foundation alone isn't a house. The people who sleep well in retirement usually have a second layer, a 401k, an IRA, something they built on the side, not because they didn't trust the pension, but because they understood what a single income source can and can't absorb. Before you sign anything, before you submit that retirement election form, there are 3 decisions ahead of you that you cannot reverse. And each one carries a trade-off that will follow you for the rest of your life. Once you submit your pension election form, that's it. Most plans don't let you change your mind. So before you sign, you need to understand exactly what you're choosing and what you're giving up. Decision 1, lump sum or monthly annuity. Your plan may offer you a choice. Take everything as one large payment up front, or take a guaranteed monthly check for life. The lump sum feels like control. You can invest it, pass it on, adjust as life changes. But here's the structural reality of 2026. We've been living in a higher interest rate environment. And when interest rates go up, the present value of your lump sum goes down. The math works against the lump sum right now in a way it didn't a few years ago. More importantly, the moment you take the lump sum, the longevity risk comes back to you. If you live to 90, you need that money to last. If the market drops 30% in year 2 of your retirement, you absorb that. The monthly annuity keeps paying regardless. Neither option is wrong, but they're not equal. And the decision depends on your health, your other assets, and your tolerance for managing money under pressure. Decision 2, spousal benefit. This one is harder because it involves a number that feels personal. Say your full pension is $2,500 a month, single life option. That means when you die, the payments stop. Your spouse gets nothing from that pension. The joint life option, sometimes called survivor benefit, reduces your monthly payment, maybe down to $2,200. That $300 difference ensures your spouse continues receiving income, typically 50% to 100% of your benefit after you're gone. $300 a month feels small until you imagine your spouse at 78, alone, trying to make the budget work without it. But there's a second path worth knowing about. Some people choose what's called pension maximization. They take the full $2,500 single life payout and use that extra $300 a month to buy a term life insurance policy. If they die first, the insurance death benefit replaces the lost pension income for the spouse. This approach gives you more flexibility and potentially more total income if both spouses live long, healthy lives. The risk is insurability. If your health changes and you can't get coverage, or if the policy lapses, the strategy falls apart. Your spouse is left exposed. There's no universal right answer here. The right answer lives in your health history, your age gap with your spouse, and what lets both of you sleep at night. Decision 3, inflation protection. This one is the quietest and probably the most underestimated. Some pensions include a COLA, a cost of living adjustment, that increases your payment each year to keep pace with inflation. Many don't. And if yours doesn't, here's what that actually means over time. A pension paying $50,000 a year today with no CORA at 3% average inflation. In 30 years, that same check has the purchasing power of roughly $21,000 in today's dollars. Same number on the statement. Less than half the real value. That's not a projection designed to scare you. That's arithmetic. I don't have a crystal ball for where inflation goes over the next decade, and I'm not going to hand you a formula and tell you to follow it blindly. Every decision here depends on your health profile, your other income sources, and what actually lets you feel secure. But I'd rather you see this number now, clearly, than discover it at 80 when your fixed check no longer covers what it used to. The people who navigate this well aren't necessarily smarter. They just looked at all three decisions at the same time, mapped the interactions, and chose deliberately, not by default. A quick note for anyone watching. If you have a government pension, a private pension, or you're still deciding whether to take the lump sum, drop a comment below. Tell me what you're working with. We can talk through it. When you've made these three choices and you know your monthly number, most people feel like the hard part is over. The income is locked in. The plan is set. That's exactly when the tax torpedo starts to arm itself. Let's go back to John. He retired. He made his elections. He's now pulling $30,000 a year from his pension and $24,000 a year from Social Security. On paper, that's $54,000 a year in guaranteed income. Comfortable. Predictable. He budgets around $54,000. His wife does too. Then the first tax return arrives. The IRS doesn't see $54,000 the way John sees it. They run a different calculation, one most retirees have never heard of before they're sitting in front of it. It's called combined income. And the formula is straightforward, but the consequences are not. Combined income equals your adjusted gross income plus any tax-exempt interest plus 50% of your Social Security benefit. For John, $30,000 from the pension plus $12,000, which is 50% of his $24,000 Social Security, equals $42,000 in combined income. The IRS threshold for a single filer is $34,000. For married couples filing jointly, it's $44,000. John is over the individual threshold, which means up to 85% of his Social Security benefit is now taxable as ordinary income, not the amount above the threshold, 85% of the entire Social Security benefit. That's up to $20,400 of income John thought was mostly sheltered, now sitting in a taxable bracket. On a modest federal rate, that's potentially $2,000 to $4,000 a year in taxes he didn't plan for. Every year, for the rest of his retirement. The check from Social Security doesn't change. The deposit hits the account the same as always, but the net, what John actually keeps, is quietly smaller than everything he calculated. I remember the first time I sat down with a client's projected tax return for their first year of retirement. We went through the Social Security worksheet line by line, watching income that was specifically designed to support people in old age get pulled into the taxable column, not through any mistake, not through any bad decision, just through the mechanical interaction of two income streams. That was the moment that changed how I think about retirement planning entirely. The numbers were legal, the outcome felt wrong, and John's situation doesn't stop there. If his pension or any additional withdrawals from a traditional 401k pushes his modified adjusted gross income above certain thresholds at age 65, he triggers something else, IRMAA, Income-Related Monthly Adjustment Amount. That's the Medicare surcharge. In 2026, A single filer whose MAGI exceeds $106,000 pays significantly more for Medicare Part B and Part D than someone just below that line. The pension that felt like a reward starts functioning like an income accelerant, pushing you into brackets and surcharges you weren't expecting, in a system that hasn't had to adjust its thresholds for inflation in decades. The $34,000 Social Security threshold for single filers. It was set in 1983. It has never been indexed to inflation. What was designed to affect only higher income retirees now captures a much wider swath of people, including many who would never consider themselves wealthy. That's not an accident of bad planning on your part. It's a structural feature of how the system was built. So what does this actually cost over time? If the tax torpedo pulls an extra $3,000 a year in unexpected tax liability, and you're looking at a 20-year retirement, that's $60,000 in after-tax income that your spreadsheet never accounted for. Not lost to a bad investment, not to a market crash, to a formula. You're receiving guaranteed income with the right hand, and returning a portion of it to the IRS with the left, at a rate higher than most people expect. The fix isn't to avoid the pension. You can't. The fix isn't to delay Social Security forever. There are trade-offs either way, but there is a window, and if you know it's there, you can use it. Most people assume the tax damage is done the moment they retire. The pension starts. Social Security starts. The brackets lock in. Nothing left to do but manage the bill. That's not quite right. For many retirees, there's a gap, a window between when you stop working and when Social Security begins, or before required minimum distributions kick in from your traditional 401k. Inside that window, your taxable income is temporarily lower than it will ever be again. That window is the most valuable planning opportunity most people never use. Here's what's possible inside it. If you have money sitting in a traditional 401k or IRA, pre-tax dollars that will eventually be forced out through RMDs, you can convert a portion of that into a Roth account. You pay the tax now, at today's rate, while your income is still relatively low. The money then grows tax-free. And when you pull from a Roth in retirement, those withdrawals don't count toward your combined income calculation, which means they don't feed the tax torpedo. This strategy is called a Roth conversion. It's not exotic. It's not aggressive. It's using the structure of the tax code the way it was designed to be used intentionally, in the right sequence, at the right time. The people who do this well aren't necessarily converting everything. They're converting just enough each year to fill up a lower bracket, keeping their income below the Social Security taxation thresholds, below the IRMAA cliff, without triggering a bigger bill than the one they're trying to avoid. This is what sequence of withdrawal means in practice. It's not just which account you pull from first. It's actively managing what shows up as taxable income in any given year, so the system works with you instead of against you. The window doesn't stay open forever. Once Social Security begins, once RMDs start, usually at age 73, your taxable income floor rises whether you want it to or not. The flexibility narrows. The cost of inaction compounds. If you don't act during the window, you're not making a neutral choice. You're accepting the default, which in this case means paying taxes at the highest rate the system will assign you for as long as you live. Money only creates peace of mind when you know exactly how much of it you actually keep. A pension is rare. If you have one, that's not nothing. In a financial landscape where most people are managing everything themselves, a guaranteed monthly income for life is a genuine form of security. But there's a difference between what a pension is worth on a net worth statement and what it actually puts in your account each month After taxes, after Medicare adjustments, after 20 years of inflation quietly doing its work. Present value on paper doesn't pay the electric bill. It doesn't cover the medical copay or the property tax. Cash flow does. Specifically, after-tax cash flow calculated carefully, planned deliberately. That's the whole game. You spent 30 years building this. The last thing you want is to hand a portion of it back to a system you didn't fully understand in time. The tax torpedo is real. The vesting cliffs are real. The COLA gap is real. But none of them are inevitable if you see them clearly before you sign. Don't let the tax system erode what took you 30 years to build. Subscribe to Wes Investor for more strategies on protecting what you've earned. I'll see you in the next one.